Did you know about the crypto market crash? If not, then don't worry, we are here to tell you all about it. Moreover, we are going to tell you about how and when the market crashed. Stay tuned till the end of the video to know about it. Bitcoin has historically seen its price down from previous highs for more than 3 years, and the latest peak took place just 7 months ago. Bitcoin, BTC, experienced one of its most brutal crashes ever in 2022, with the BTC price plummeting below $20,000 in June after peaking at $68,000 in 2021. June 2022 has become the worst month for Bitcoin since September 2011, as its monthly losses mounted to 40%. The cryptocurrency also posted its heaviest quarterly losses in 11 years. However, the current market sell-off doesn't make Bitcoin crashes and bear markets exclusive to 2022. In fact, Bitcoin has survived its fair share of crypto winters since the first Bitcoin block, or the Genesis block, was mined back in January 2009. Since January, Bitcoin has fallen as much as 60% and is currently trading at about $23,000. Ethereum, which supports smart contracts and programmable tokens on a blockchain, has slumped as much as 75% so far this year and is currently buying about $1,500 compared with $4,500 at its peak last November. The ongoing bear market is largely attributed to the crisis of algorithmic stablecoins, namely the TerraUSD Classic, USTC, stablecoin, which are designed to support a stable 11 peg with the US dollar through blockchain algorithms rather than equivalent cash reserves. USTC, once a major algorithmic stablecoin, lost its dollar peg in May. The depegging of USTC triggered a massive panic over broader crypto markets as the stablecoin had managed to become the third largest stablecoin in existence before collapsing. The collapse of Terra caused a domino effect on the rest of the crypto market due to massive liquidations and uncertainty that fueled a crisis in cryptocurrency lending. A number of global crypto lenders like Celsius had to suspend withdrawals due to their inability to maintain liquidity amid brutal market conditions. Bitcoin has historically seen its price trade below previous highs for more than 3 years. The previous peak of $68,000 took place just 7 months ago, and it's yet to be seen whether and when Bitcoin would return to new heights. Values have been falling for 8 months, although there was a small upswing in prices across July. Nevertheless, experts are wary of calling the bottom. The crash hasn't just been limited to the 2 major currencies, but also smaller projects with associated tokens designed to perform hundreds of different functions from efficiency to governance to loans. The likes of Solana, Avalanche and Cardano are projects working to quicken the time of coin-to-coin transactions and to cheapen costs. Since January, Solana has fallen 76%, Avalanche has dropped 78% and Cardano is down 63%. Decentralized finance, or DeFi, as it is also known, has taken a hit too. This is a subsector using blockchain technology to replace traditional banking functions. Each DeFi system has its own priced token to help it fund its operations. Some systems connect lenders with borrowers and depending on how much demand there is on either side, calculate an interest rate for investors who tip money in. These are called automated lending protocols, and the biggest ones are Aave, Maker and Compound, which have fallen 65%, 59% and 72% respectively. DeFi also boasts automated market makers or decentralized exchanges, which automatically connect buyers and sellers and also provide liquidity to marketplaces. The biggest ones are Uniswap, Curve and PancakeSwap, which are down 60%, 78% and 67% respectively since January 1st. Australian DeFi projects include Synthetix, which is down 38%, and Maple Finance, which is down 14%. Cryptocurrencies are being sold off as the widespread collapse of several large crypto banks and hedge funds. Most notably, Three Arrows Capital and crypto lender Celsius, both of which have filed for bankruptcy. Just like in the global financial crisis, these collapses come down to huge amounts of leverage and borrowing in this latest crypto cycle. In May, an algorithmic stablecoin called Terra Luna collapsed. It was meant to remain firmly pegged to the US dollar through a trading mechanism. But the team behind the coin was paying traders 18% interest to keep the coin stable. Terra Luna was very widely held as a stable coin, and when it suddenly fell to $0, many businesses were in trouble. One was Singapore-based Three Arrows Capital. Not only was it heavily exposed to Terra Luna, but it had also taken out loans it was unable to pay back once the crypto collapse took place. Another collapsed crypto business was Celsius, which offered customers returns of over 18% for depositing their digital assets. Celsius had taken those deposits and traded them in high-risk markets behind the scenes to earn the interest to pay back to customers. One investment was actually in Three Arrows Capital, an illustration of the market contagion that has crypto investors nervous. It turns out a lot. Grayscale Trust, BlockFi, and Voyager are just some of the names that had huge holes blown in their balance sheets when Three Arrows collapsed. Another crypto bank, Babel Finance, is also struggling to stay solvent. Turns out Babel was also taking depositor money and trading it without any risk controls behind the scenes. Australian-founded cryptocurrency exchange ZipMex has been caught up in the turmoil, last month announcing it was trying to claw back $69 million it had lent to the Rocky Bank. It's worth noting these businesses are all centralized organizations. They are run by teams of people who made decisions about how much they wanted to borrow against their deposits. Unlike traditional stock exchanges, which have automated circuit breakers that halt trading if the market starts selling off drastically, crypto businesses couldn't stop the flow of money out the door in time. They were also borrowing more and more crypto to turbocharge their returns. They took huge risks and it blew up. The contagion within crypto markets hasn't spilt over into other markets, but looking under the hood reveals just how interlinked many of these crypto projects are. To market observers, the crypto organizations built on-chain using decentralized systems have withstood the widespread carnage. They say the blockchain-based technology that connects buyers and sellers, or lenders and borrowers, may be experiencing less activity than usual, and their automated yield calculations might be lower, but the technology itself hasn't broken. In fact, many investors are pleased the sell-off has swept some of the overhyped, frenzied and unsophisticated investors obsessed with speculation out of the market. That would be it for the video. If you enjoyed it, kindly like the video and subscribe to our channel.